Welcome to CMA USA Exam Coach, your ultimate destination for mastering the CMA USA syllabus with clear, concise, and engaging lessons. Today we are officially kicking off our journey, starting with an essential topic, Comparative Financial Statement Analysis, Part 2, Section A. In this lesson, we'll break down the concept, understand its importance, and explore how it helps businesses make informed financial decisions. So get ready to dive into the world of financial analysis with us. Before we get started with financial statement analysis, let's first go through two fundamental financial reports, the contribution income statement and the balance sheet in financial reporting. These are concepts that most of you are already familiar with, but it's important to quickly revisit them as they play a key role in understanding financial analysis. So, let's explore them before we move forward. Contribution income statement. Now, let's talk about the contribution income statement, a powerful tool used in managerial accounting. Unlike the traditional income statement, which follows the GAAP format, the contribution income statement classifies costs based on their behavior, variable and fixed costs, instead of function. It follows a simple structure. The sample income statement you see here will be used throughout our lecture to explain various analyses and ratios. As you can see, it begins with revenue, from which we subtract variable costs. These variable costs include all direct, indirect, and other variable expenses. This gives us the contribution margin, a key figure in decision-making. Next, we subtract fixed costs, which leads us to operating profit. From operating profit, we then account for interest and taxes to arrive at the final figure, net income. The key focus here is the contribution margin, which tells us how much revenue is available to cover fixed costs and generate profit. This format is especially useful for decision-making, cost-volume profit analysis, and evaluating profitability at different sales levels. A company must be capable of generating a contribution margin that exceeds its fixed costs in order to be considered profitable. The contribution margin represents the revenue remaining after variable costs have been deducted, which helps cover the company's fixed costs. Once the contribution margin surpasses these fixed costs, the company begins to make a profit. Therefore, achieving a contribution margin higher than the fixed costs is essential for profitability. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It is divided into three main sections: assets, liabilities, and equity. Assets are what the company owns, and they are categorized into current and non-current assets. Current assets are assets that can be converted into cash or used up within 1 year, such as cash, receivables, and inventory. Non-current assets are long-term investments, property, plant, and equipment, which are not expected to be converted into cash within a year. Liabilities represent what the company owes, and like assets, they are classified into current and non-current. Current liabilities are debts or obligations due within 1 year, such as accounts payable and short-term loans. Non-current liabilities are long-term debts, such as bonds or long-term loans, that are due after 1 year. Equity represents the owner's claim on the assets after liabilities have been deducted. It includes retained earnings, common stock, and other shareholder contributions. For a company to meet its working capital needs, its current assets should exceed its current liabilities, ensuring that there is enough liquidity to cover short-term obligations. A positive working capital indicates that the company can meet its operational needs and continue growing. Let's continue with comparative financial statement analysis. This method is used to evaluate a company's financial performance over multiple periods by comparing financial statements side by side. It helps stakeholders identify trends, assess financial stability, and make well-informed business decisions. There are several key methods to analyze financial statements, including ratio analysis, evaluating financial health using key financial ratios; horizontal analysis, comparing financial data over different periods to identify growth or decline; vertical analysis, analyzing financial statements by expressing each item as a percentage of a base figure. By applying these techniques, businesses can gain valuable insights into their financial position and performance trends. In this episode, we are going to explain horizontal and vertical analysis. These are two important methods used in financial statement analysis. Horizontal analysis. Let's dive into horizontal analysis. This method compares financial data over different periods to identify trends, growth patterns, and changes in a company's performance. Horizontal analysis, also known as trend analysis. By analyzing year-over-year changes in financial statements, stakeholders can assess whether the company is improving, declining, or remaining stable. Horizontal analysis is useful for spotting revenue growth, cost variations, and profitability trends, helping businesses make strategic decisions based on historical performance. Let's explore how this analysis works in detail. To calculate the percentage change using horizontal analysis, we use the formula. Percentage change equals to current year value minus previous year value divided by previous year value multiplied by 100. This equation expresses the relative change in financial statement items over time. Steps of horizontal analysis. Step 1. Select the financial data for comparison. Identify the specific financial statement line items, example revenue, net income, total assets, you want to analyze. Choose the time periods for comparison, such as year over year or quarter over quarter. Step 2. Calculate the dollar and percentage change. Find the difference between the current year's and the previous year's values. Apply the above percentage change formula. A positive result indicates growth, while a negative result signals a decline. Step 3. Interpret the results. Analyze whether the changes are positive or negative and determine the reasons behind them. Consider external factors and internal factors affecting the changes. Use insights to make informed business decisions and forecasts. As per the example shown, the company's revenue in year 1 was $5,600,000, and in year 2, it increased to $6,720,000. To calculate the percentage change using horizontal analysis, we first determine the difference by subtracting the year 1 revenue from the year 2 revenue. Then we divide the difference by the year 1 revenue to find the proportion of change. Finally, we multiply the result by 100 to convert it into a percentage. So there is a 20% increase in the revenue from year 1 to year 2. Vertical analysis, also known as common size analysis, is a financial analysis method used to evaluate the relationship of individual financial statement items to a base amount within the same period. It helps in understanding the proportion of each item in relation to a total, making comparisons easier across different periods or companies. In the income statement, each line item is expressed as a percentage of total revenue. In the balance sheet, each item is shown as a percentage of total assets or total liabilities and equity. This method allows businesses and analysts to identify trends, strengths, and weaknesses by assessing the composition of financial statements. It is useful for benchmarking a company's performance against industry standards or competitors. Let's discuss the concept of vertical analysis with the example shown. To determine the percentage of cost of goods sold in relation to total revenue, we first take the COGS value of $2,240,000. Then we divide it by the total revenue of $5,600,000. Finally, we multiply the result by 100 to express it as a percentage. This gives us 40%, meaning that COGS accounts for 40% of total revenue. Now, let's look at another example using net income. The net income is $689,000, and the total revenue remains $5,600,000. To find the percentage, we divide net income by total revenue and then multiply by 100. This results in 12.3%, indicating that net income makes up 12.3% of total revenue. This analysis helps in understanding how different financial elements contribute to the overall financial performance of a company. Now, let's discuss vertical analysis for balance sheet items using the example shown. To determine the percentage of cash in relation to total assets, we take the cash amount of $1,500,000. Then we divide it by the total assets of $11,500,000. Finally, we multiply the result by 100 to express it as a percentage. This gives us 13.04%, meaning that cash represents 13.04% of total assets. Now, let's consider another example with long-term investments. The long-term investment value is $3,500,000, and the total assets remain $11,500,000. To calculate the percentage, we divide the long-term investment by total assets and then multiply by 100. This results in 30.43%, indicating that long-term investments make up 30.43% of total assets. This analysis helps in understanding how different assets contribute to the company's financial structure. Now, let's look at the table that highlights the differences between vertical and horizontal analysis. Please note it down and make a summary for better understanding. To clarify the key distinction, vertical analysis is used to compare different companies within the same industry by analyzing financial statements as a percentage of a base figure. Horizontal analysis focuses on evaluating the financial performance of the same company over different periods, helping to identify trends and changes over time. This comparison will help you understand when to use each type of analysis for financial decision-making. In this episode, we discussed horizontal and vertical analysis, understanding their concepts, calculations, and significance in financial statement analysis. Hope you now have a clear understanding. Make sure to practice the questions from your CMA support pack. The more you practice, the better clarity you gain on these concepts. Remember, conceptual clarity is key to mastering financial analysis. Thank you for watching! If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you don't miss any updates. In our next episode, we'll explore financial ratios, a powerful tool to assess a company's profitability, liquidity, and overall financial health. Stay tuned and see you in the next episode.